that's been raised in the industry. One of the topics covered is how to reflect the new financial reporting requirement, the ability to cross-subsidize between cohorts, which is an inherent and important feature of risk sharing in Takaful. Now, before I introduce Joanne, a bit of housekeeping. First, you need to scan in your attendance. If you look at the QR code on the chat box, so if you're an ASM member, please scan in your attendance for CPD purposes. If you have questions, please type in your questions. You need to open a separate window. Go to slido.com. The code today is 18167. And type in your questions there. We'll monitor it and get to those questions at the end of the presentation. So let me introduce Joanne. Joanne is a principal and actuary at APC. She is a fellow of the IFOA with more than 10 years post-qualification experience. She has many experience in statutory evaluation, profit reporting, M&A for both conventional and Takaful companies. On 17, Joanne's been involved in various 17 works, which includes performing financial impact analysis, reviewing gap analysis, and conducting 17 trainings and workshops for the insurance industry in a few countries, Malaysia, Sri Lanka, Brunei, and Pakistan. So we welcome her. Joanne?
Thank you, Aiza, and thank you, everyone. Let me share my screen.
Sorry, Joanne, we can't hear you. We need to somehow unmute, yeah, or louder.
You hear me now? No? Can you hear me now?
Okay.
You hear me? Okay, good.
Yeah.
Okay, let me share my screen. Okay, good morning, everyone. Thanks for joining me today in today's webinar. Actuarial Partners has been in collaboration with ASM to come up with a series of webinars on Takaful topic. Today's session is the last series for this webinar. So if you have been following the webinar series on Takaful, you're probably aware that the differences between a conventional insurance and Takaful business. And in Izizana webinar earlier this week, we understand that MASB has proposed that IFRS 17 should be applied to Takaful business. So the question now is, how do we ensure that the distinct features in Takaful can be reflected in the account in IFRS 17 account? And for this session, we are going to discuss how these features should be reflected in the IFRS 17 reporting and various practical considerations in implementation. So the agenda today, I'm going to go through the two-column approach proposed by MASB for the Takaful financial statement, and in particularly what you need to know while you prepare the account for this two column. Then I'll go through some example on the challenges of applying the visualization features in Takaful entity reporting. And finally, we'll talk about potential operational challenges for IFRS 17 reporting. So various discussion on how to apply IFRS 17 on Takaful is still ongoing. So recently, MASB has proposed that columnar presentation to be adopted for Takaful Fund and Takaful entity. So under the columnar approach, two columns will be used to present the financial of the Takaful business. Each column should be prepared on a standalone basis, and each column must be IFRS compliant on its own. So what does this mean? So typically in insurance company, in the Takaful operators, let's say for life or for family Takaful operator, we typically have three funds. PIF is for participants investment fund, we have participants risk fund, we have operators fund. There are clear segregation of funds in Takaful. So PIF and PRF, we group it together and call it Takaful fund. They are owned by participants, whereas operators fund is owned by shareholders. The first column shows the financial of the Takaful fund. Although Takaful Fund is not a legal entity, however, this is the party that accepting insurance risk, and hence IFRS 17 standards should be applied for the accounting of Takaful Fund. On the other hand, Operators Fund is actually providing a service to the Takaful Fund for managing the business. In returns of the services, they actually get a fee for this service. So because they are providing a service and getting a fees for that, you can argue that IFRS 15 can be applied to Operators Fund on standalone basis. The other column in the proposed presentation is Takaful Entity. So Takaful Entity is, we are talking about the whole entity is a combination of PIF, PRF, and OF. So at the entity level, this is the entity that conducting insurance business. Remember, IFRS standard is about accounting standard for insurance contract issue, not applicable to the entity, but applicable to the contract itself. So because the Takaful business involves issuing insurance contract, and hence IFRS 17 applies at entity level. The proposed approach having two columns in the financial statement is quite important. The Takaful Fund is owned by participants, and hence participants will be interested to know the financial about the Takaful Fund, whether the Takaful Fund is healthy, whether when they contribute additional tabaru to the fund, whether whether the fund has a card or something like that. So they want to know the financial about Takaful Fund. Whereas for Takaful entity perspective, this is more for investor to know whether the entity is generating enough returns to the investor, whether they are making money, whether the contract that they issue are profitable or not. So in the next few slides, we are going to discuss more about the differences between the two columns. So let's look at the presentation of Takaful Fund financial statement. So this is the first column. Takaful operator is a manager and administrator of the Takaful Fund. And in returns to that, Takaful operator get a fees from the Takaful Fund. So performance fee is considered as expenses from the Takaful Fund's point of view. So they get a fees by doing the administration of the fund. Okay, so from the PRF perspective, you will have income of tabaru, you will have an outgo of claim, and you also have an expense outgo of the performance fees. If there is still remaining surplus in the PRF fund, participants are sharing 100% of that. The way that Takaful Fund works is very similar to a mutual. Under a mutual, the entity is owned by policyholder, and the policyholder is also entitled to receive the profit generated by the mutual entity. Okay. Level of aggregation is a hot topic recently, and recently ISP has agreed that they are going to have annual cohort for all the Takaful contract or for insurance contract. However, whether it makes sense for Takaful to apply annual cohort requirement where the fundamental of Takaful is based on mutual assistance between participants. From the Takaful Fund perspective, all the remaining surplus belong to participants, and there is no CSM in the Takaful Fund. Remember, CSM is talking about the present value of future profit that shareholders can get from the business. So under Takaful Fund, because 100% of the remaining surplus belong to participants, there's no CSM. There's no CSM, there's no annual cohort requirement, because BC 138 of the standard says, if the accounting outcome of using annual cohort is the same of the outcome of not using the annual cohort, then it is not necessary for the entity to apply annual cohort requirement. So annual cohort, I'll go through that later. Annual cohort is that you're grouping a few policies together and you will need to track the profitability of the group of contract going forward. So the idea of having annual cohort is the tracking of the profit to the shareholders. So given that shareholders is not entitled to any remaining surplus in the Takaful Fund, and hence annual cohort is not really necessary. So what we have concluded so far for Takaful Fund. So the first thing is Takaful Fund is a mutual entity that undertake the insurance business. Secondly, participants have two roles in the fund. First role is as a policyholder. They pay in the tabarruk with the understanding that the tabarruk will be used to help other participants in the fund. The second role of the participant is they are also the owner of the fund. If there is any surplus left in the fund, they are entitled to share the surplus of the fund. The third feature is Takaful operators get the performance fees from the Takaful Fund. And from the Takaful Fund perspective, it is an expense from the fund. And hence the performance fees will be formed as part of the fulfillment cash flow of the Takaful Fund. Given the Takaful Fund is a mutual entity, annual cohort is not necessary because this will give the same accounting outcome as if you don't apply annual cohort to it. Now, presentation of Takaful Fund. ISP issues some education material on how to apply IFRS 17 to Takaful, to insurance entity. They also issue education material on how to apply insurance contract issued by mutual entity. So ISP recognized that there is no shareholders in the mutual entity. So the disclosure requirement may be different between conventional insurance and mutual entity to cater for different needs of the stakeholder. So for mutual entity, the financial statement should disclose the liability in the insurance liability for policyholder for the capacity as policyholder, and separately identify the liability attributed to policyholder with the capacity of them being the owner of the fund. Okay. So the insurance liability in the capacity of policyholder will be calculated based on cash flow like tabarruk, claims, and performance fee as expenses. When there's any remaining surplus left to the policyholder, so that will be used to calculate the liability attributed to policyholder with the most residual interest in the entity. The requirement implies that, and separately, that's for balance sheet. For revenue account, we also have to separately identify the income and expenses that attributed to policyholders separately for their role as policyholder and also for their role as the owner. So the requirement implies that present value of surplus to participants can be actually disclosed separately from the liability of the insurance contract. Okay, so given the annual cohort is not necessary, reporting at the overall fund level is sufficient. Okay? Because we don't have to split the cash flow into annual cohort, there's no CSM calculation required. So what you can do is you just do the runs on your actual model, sum up the cash flow, and then report at the fund level is sufficient. So there's no reallocation of cash flow is required. I will go into more details on what I meant by reallocation of cash flow. I'll give some example later on. So we are done with Takaful Fund. Now we talk about Takaful Entity. As I mentioned just now, for Takaful Entity, the investor will be interested to know the profitability of the contract issued by the entity. So because they want to know the profitability of the full contract, hence overall cash flow from the PIF, PRF, and OF will have to be taken into account. One thing to note that because now we are looking at things from different perspectives, we are looking this accounting from shareholders' point of view. We interested to know what is the CSM for this business. CSM, as I mentioned, is present value of future profit for the contract written by the company. Okay, so now things are different slightly. So just now I mentioned that performance fee is part of the fulfillment cash flow in the Takaful Fund. However, from Takaful entity, this is slightly different because now this is the income to the entity. So performance fees will not be formed part of the fulfillment cash flow. This will be reflected as part of the CSM instead. So as I mentioned, annual cohort is splitting the policy into groups depending on the commencement date, profitability features and whatnot. And then we have to track the profitability of the contract based on this annual cohort requirement. So we have a challenge here. As we mentioned just now, Takaful Fund is a mutual entity. They are sharing surplus across the fund for all the participants. So how do we reflect the mutualization of Takaful Fund into the annual cohort requirement in the Takaful entity reporting? There is a certain provision in the IFRS standard. We refer that to B67 to B70. These are the 4 paragraphs in the IFRS 17 standard to say that, okay, the company can allocate cash flow between the different IFRS 17 group if the contract features allow for it. Okay, what this means is that we will need to reflect the cash flow after allowing for the sharing of risk or sharing in surplus in the PRF, and then use the mutualized cash flow to determine the profitability of the groups for the contract. What this means is allocation of surplus in the PRF is quite important because this determines the amount of fees that the Takaful operators can get from the particular IFRS 17 groups, and which in return will affect the overall profitability for the group. How the surplus is being reallocated in PRF would have implication to the CSM calculated for that group. So what do I mean by reallocation of cash flow? So when I mention B67 to B70, basically is talking about reallocation of cash flow in PRF fund. Okay. Annual cohort means that we're going to group the policy into different groupings based on the commencement date, based on the profitability features of the contract. And then the profitability will have to be tracked based on the cash flow from the same group. You can't move the cash flow around, okay? But B67 and B70 says that we can do that if the product features allow for that. Okay, TOF says that the remuneration for the Takaful operator shall be determined based on proportion of distributable surplus. Okay, this is determined at the fund level, the PRF fund level, not at the policy contract level. And the surplus would then be allocated down the group level. Okay, when we have the overall PRF in a surplus position, then OF will be able to get the performance fees. One thing to note that is, you should not have a situation whereby within the same PRF fund, you have some groups having negative performance fees and some group having a positive performance fee. Why is that? Because the determination of surplus or deficit is actually done at the fund level, not done at the policy level. So you should have some consistent fact of whether the fund is in surplus or deficit. So if the overall fund is in a surplus position, all the groups should actually show a positive PRF cash flow. On the other hand, if the PRF fund is in deficit, all the groups should show negative PRF cash flow. Therefore, it's important to ensure that the mutualized distributable surplus for each of the group can be determined correctly. So the allocation of the surplus, so we determine the surplus at the fund level. how you allocate the surplus back to the individual policy or back to the group can be determined by the company surplus distribution policy. Okay? It can be allocate back the surplus based on number of policy, unlikely this is the case. It can be distributed back as a proportion of tabarruk contributed by the policyholder or proportion of the surplus contributed by the group, for example. So it depends. So there are many ways you can do it, but the company will need to determine how you're going to determine it. So how do we do that? You can think that the PRF cash flow has a few components. First, just look at the first two components, tabarruk and claim. When you do a projection in the actual model, you should be able to determine, calculate the tabarruk and claim based on the policy information such as age, sum assured, and whatnot. When you do the first run, you should be able to determine whether the group or whether the policy has a surplus. Surplus means the tabarruk is higher than claim. Or deficit. Deficit means when the claim is higher than the tabarruk. Okay. Under the risk sharing model in PRF, B67 to B70 of IFRS standard allow you to move cash flow from profitable group to non-profitable group to cover the deficit in the non-profitable group. Okay. After the reallocation of cash flow, then you can determine the surplus distribution to participants and also the performance fee. So this is the last two components in the PRF cash flow. So the reallocation cash flow is basically moving cash flow from profitable groups to less profitable groups. So you need to readjust the cash flow in the PRF before you can determine the distribution to participants and the performance fees to the operators. So what do you need to do to reflect this B67 to B70 in the Takaful entity reporting? First, you need to determine how much surplus is available for surplus distribution. You need to take into account the surplus distribution policy in your company. So for example, the surplus distribution of policy for your company may say that if there is any surplus arising during the year, you first need to cover the underwriting losses for loss-making policy. And then you can repay if you have any outstanding card. And then you can use the surplus for this purpose and that purpose, or you probably can retain some of the surplus in the fund, in the PRF fund as contingency liability, for example. Only if there's any remaining surplus, then you can determine how much to distribute to participants, and then equivalent amount of performance fee can be given to the entity. So first of all is to determine what is the amount that you can distribute out based on the fund position. Secondly, you need to determine who to distribute the surplus to. Okay, what does your surplus distribution policy say? Is the surplus only distributed to in-force policy only, or policy that out of force during the year would not be entitled to any surplus distribution? So you need to take into account of that. So how do you determine for each participant how much of surplus they are entitled to? Is it based on the tabarruk contribution that the policyholder contribute to the fund? Okay, so for the larger policies or for policy with higher sum assured, will be entitled to higher surplus in the case. I've also seen surplus distribution policy for non-Malaysian client that surplus can only be distributed to profitable contract only. So only when the tabarruk is higher than expected claim, they're entitled to surplus. For the loss-making policy, they are not entitled to the surplus. So when you try to reallocate the surplus from fund level to the individual policy or the group, you need to pay attention of what your surplus distribution policy says, and you're trying to allocate it based on that. So for the next few slides, I'm going to show some simple example on how to reflect B67 to B70 in your Takaful entity reporting. Okay, so assuming we have 5 groups in the whole entity, and we have only a 1-year policy for now, just to show a very simple example. So the entity maintains 3 funds. There's Participants Investment Fund, Participant Risk Fund, and Operators Fund. So for each of the fund, because the funds are segregated between the fund, and each of the fund has different features, like for example, Participant Investment Fund, the purpose is to do investment. So the investment, they get some investment income, and Takaful operators will take a proportion of the investment income as performance fees. Typically in Malaysia, the Takaful operator take 10% of investment income as the performance fees. The fees from PRF is more challenging because there are different pricing assumptions and different experience for different type of contract. So you may have some groups having positive cash flow, some group having negative cash flow. But as long as the overall fund has a surplus position, the performance fees will be actually determined at the fund level, not at the individual policy level, as I mentioned just now. So when there is a surplus in the total fund level, then the operators can take up to 50% of the underwriting surplus in the PRF fund. So when we determine whether there is a surplus distribution or performance fee, is look at the fund level, not the individual policy level. But however, if you look closer into the cash flow for each of the 5 groups, some of the groups have negative cash flow. Negative cash flow means the expected claim are higher than tabaru. So we have negative cash flow for group 2 and group 4, whereas we have a positive cash flow for group 1, 3, and 5. So this one is just a difference between the tabaru and claim. We haven't talked about the reallocation of cash flow yet. So under the mutual model that maintained by the PRF fund, by right, we should be sharing the surplus across all the groups, all the policy. So by right, we should allow the surplus from group 1, 3, and 5 to fund for the deficit for group 2 and 4. Okay, and the overall surplus, once you help each other, then you will have a remaining surplus of 10. Okay, and then you can determine the performance fee will be 50% of the 10, which is 5. Okay, I need to emphasize this point. Okay, the fees to Takaful operators is dependent on the surplus distribution to the participants. So when we reallocating the surplus within the PRF fund, then the performance fee for the Takaful operator would hence be indirectly being reallocated. So I just want to emphasize the point that we are not reallocating the profit to the shareholders, but we are reallocating the surplus within the PRF fund, and as a consequences of that reallocation, that would affect the performance fee to the operators. Lastly, we have expense surplus because operators fund is owned by the operators, and hence they're entitled to 100% of the expense surplus in the operators fund. Okay, so this slide is to emphasize that shareholders get different percentage of the surplus coming out from different funds. Now, just now we're showing the surplus from each fund. Now, this slide is showing the fees the Takaful operators get from each of the funds. Okay. So as we mentioned just now, for PRF, it's 10% of the investment income. PRF, we take 50% of the underwriting surplus. OF, we're taking 100% of the surplus. And then we have a total expected profit, which is the summation of these 3 columns. So under this slide, we are assuming no allocation of cash flow. Okay. So under this scenario, group 4 and 5 are onerous. Okay, for group 4, what the number is showing is that the operator or the shareholders get $1 of fees from PRF fund. However, the shareholders paid out $25 to the PRF fund. And they also get $20 from the operators fund. And the net result is they actually paid out $4 for this group of contract. But is this correct? The overall PRF fund is actually in surplus position. So the entity or the shareholders never actually paid out money to cover the loss for Group 4. Because as I mentioned, the fees or whether they get whether there's a surplus or a loss is determined at the fund level, not at the individual level. So if we reflect the mutuality in the PRF, then the fees from the from Group 4 from the PRF fund should be a positive number, not a negative 25. Hence, if we do not allow for mutualization features in the fulfillment cash flow, then the account prepared under this basis will not reflect how the business is actually being conducted. Okay, so over here we say we shouldn't have negative fees when the overall fees are positive. Okay, so we should only have one truth. If the whole fund is positive, then all the groups should show a positive features as well. And we need to find a carrier to allocate the total surplus to each of the group. As I mentioned, it depends on the surplus distribution policy. You can distribute back based on number of policy. You can distribute that depending on the tabarut contributed for each of the groups, or you can only distribute back to the contract that contribute to the surplus. Okay. Okay, so yeah, that's done. Next one. So, okay, this table shows the performance fee and profit, assuming there's reallocation of cash flow. I just do a very, very simple way of reallocation of cash flow in the PRF fund, whereby we see from the earlier slide, the underwriting profit in the PRF fund is 20. It's 10, sorry, it's 10. And then we divide by 5 groups. So each of the groups get a surplus, remaining surplus of 2. The performance fee is 50% of the remaining surplus. So each of the group get $1 as a performance fee from each of this group. Please note that when I do the reallocation, the total at the bottom does not change. What I've changed is just that I'm reallocating the cash flow between groups. Okay, I've simplified the work to reallocating the cash flow. As I mentioned just now, the reallocation of cash flow can be quite complicated because you need to take into account what your surplus policies say and who to distribute the surplus to. So if you want to take into account all those considerations in your allocation, it can be very complicated. You'll now see that the total profit at the last column changes as well due to the reallocation of cash flow. Now, instead of having 2 owners group, you only have 1 owners group. The deficit in Group 4 is now disappearing because just now the negative is mainly contributed from the PRF cash flow, which is actually not true because, as I mentioned, the shareholders never actually fork out money to cover the deficit in Group 4. It was, by right, the surplus from other policyholders are used to cover the deficit, not from the shareholders. Okay, now imagine that the actuarial models give you a long-term cash flow, and I presented some sample in this slide. So in the earlier example, I'm just assuming a 1-year contract. However, typically in a family business, we typically have a very long cash flow depending on the contract boundary of the contract sold by the company. So if the company is selling whole life product, then the projection period can be up to 99 years. Okay, so one thing I want to point out is that the reallocation of cash flow in the PRF fund is an entirely different process from amortization of CSM. I think many people probably have a misunderstanding of that. So I just want to point that out. So you can try to imagine that the reallocation of cash flow is done across all policy within the same projection period. So we are just moving cash flow within the same projection period. We are not moving cash flow across the different projection period. Okay, you can imagine that as a vertical reallocation of cash flow between groups. However, only after you do the reallocation of cash flow vertically, and then you will come up with a different expected profit at the last column, then you can use that to calculate the profitability of the group. And then the CSM amortization is basically spreading the total profit over the remaining duration of the groups of contract. So you can imagine that as horizontally reallocation of profit. So one is vertical and one is horizontally. You will have to do the reallocation vertically first before you can do the CSM calculation horizontally. Okay. The actual cash flow produced from the model is based on individual policy information, for example, age, sum assured, and the mortality assumption as well. So you can only, as I mentioned, you can only do the reallocation of cash flow after you know what is the overall position at the fund level. So it is likely that the company will have to do at least 2 runs. One run is just to determine what is the cash flow based on the policy information. And the other cash flow, when you know what is the fund position, then you can do the reallocation. Okay. So just now I showed that the reallocation for 1-year contract. So if you have you have a very long-term process, long-term contract, you have to repeat this reallocation of cash flow for all your projection period. So you do the first projection period based on the total expected surplus coming out from projection year period 1. For projection period 2, you know that at the total surplus at the total net surplus at the fund level is 15, and you reallocated the 15 into a different group. By reallocating the cash flow in PRF, it will affect the overall total expected profit at the 4th column as well. And you keep doing it until the end of the projection period. Okay. Then, if you have a different PRF sub-fund, then the same process will need to be repeated for each of the sub-fund, because different sub-fund may have different surplus position, and based on the Bank Negara rules, you can't use the surplus from one sub-fund to subsidize the deficit in another fund, for example. So each of them will have to be done independently. Okay, so for the financial year end, you will have to do many runs. First, you need to do 1 run for your base. After you're done with your base scenario, you need to repeat the process for scenario with different assumption or different data. So just now we have seen that if you have a whole life product, you have a projection period up to 99 years. You need to do the reallocation 99 times for the base scenario. And then once you rerun using a different mortality assumption, now the cash flow in your PRF fund changes, because now we have a different perspective of the future claim outgo. Then you have to redo it again based on the different mortality assumption. You have to reallocate the cash flow in the PRF fund and then recalculate what is the expected profit for them. So you need to do it another 99 times for a change in mortality. And then next round, you probably want to change a lapse rate. Again, lapse rate will have will affect your cash flow. And then you need to do it when you add on the new data. Add in the new data will give you a different net surplus at the fund level as well. And then you need to reallocate it again and again for many, many times. Okay, so that probably give you an idea how complicated it is to do the B67, B70 in Takaful entity reporting. So let us just quickly summarize what we have discussed so far. Okay, so at the beginning of the presentation, we have concluded that Takaful Fund is like a mutual entity. So for mutual entity, ISB did mention that because mutual is different from a conventional insurance, hence the disclosure for mutual, you may need to do it slightly differently to cater for the fact that there's no shareholders and to cater for the fact that policyholder has two roles in the fund, one as the policyholder and one as the owner of the fund. So, as I also mentioned, there's no annual cohort, there's no CSM in the Takaful Fund. If you look at the last row, VL, so we mentioned claim and surplus sharing can be disclosed separately because the fact that policyholder, they are the policyholder, and for the surplus sharing perspective, they need to know the information as the capacity of the owner. So because we are reporting the whole account at the fund level, because we don't have to split it into annual cohort and CSM, reallocation of cash flow is not that crucial. As we gone through just now, the reallocation of cash flow is more for Takaful entity perspective because we need to identify what are the profit coming out from that groups or contract, and hence we need to make sure that the cash flow in the PRF fund can be allocated correctly to report such that the CSM reported for that particular group or contract is accurate. And hence, so on the left, Takaful Fund level, reallocation of cash flow is not crucial. On the right, on the Takaful entity level, reallocation of cash flow between groups are crucial. Okay, for the RA, risk adjustment. Okay, risk adjustment, the IFRS 17 required the entity to report risk adjustment. And what's the purpose of risk adjustment? The risk adjustment is compensation to the entity for taking on the non-financial risk. So this is the definition. So what is entity means? For the Takaful Fund perspective, given that this fund is owned by policyholder, if you interpret the entity here is a legal entity, okay, it's a shareholders, talking about shareholders, shareholders is not, is not taking the underwriting risk for the Takaful funds. And hence one argument is saying that because of that, they shouldn't have any RA in the Takaful fund. However, there's another interpretation for this. The other interpretation is Takaful Fund is an entity. Even though Takaful Fund is not a legal entity, however, it is the reporting entity that undertaking the insurance risk. So entity, I have checked IFRS 17 standard, it doesn't really define what entity means. Is it a legal entity or a reporting entity? So currently there are two interpretations in the industry, whether to allow for RA in the Takaful Fund reporting. For Takaful entity, it is quite clear. Takaful entity take on expense risk, so they will need to get a compensation for the entity to take on the expense risk because the definition of RA is non-financial risk. So non-financial risk, expense risk is part of the non-financial risk. Then what we can go through, what are the implications to the actual modeling in PRF? So when we do the actual model, just now I mentioned briefly, for the PRF, the cash flow will be tabaru as income, claim as outgo. And the IFRS 17 standard also requires us to produce the gross cash flow and RI cash flow differently. So in the first run, you will produce the cash flow based on the policy information, age, sum assured, mortality assumption, and whatnot. And you can determine the net surplus after you have the gross cash flow and RI cash flow, because the net cash, the net surplus should be calculated after taking into account the reinsurance cash flow as well. Okay. If you think the PRF should also report RA as well, then you need to do another run based on BE plus RA assumption. Again, you need to do it for gross cash flow, RI cash flow separately, and from there you can determine the net surplus at BE plus RA basis. So the net surplus in run 2 should be smaller than the net surplus in run 1 because with the RA assumption, your expected claim is going to be higher. Okay. Remember just now we mentioned that for Takaful Fund, because it's a mutual, you can actually disclose your liability for the policyholder as a capacity of policyholder and for the present value of surplus differently. So from there, and also the fact that we can actually report it at the total fund level, not at the cohort level because there's no annual cohort reporting. So once you do these 2 runs, you basically can do the reporting for Takaful Fund. Okay. However, for Takaful entity, you can't do that because remember, we need to do the reallocation of cash flow in the risk fund. So once we have run 1 and run 2, then we can determine the net surplus at the total fund level. And then once you know what is the fund level, then you can quantify the parameter on how to allocate the overall surplus back to the individual policy based on your projection result. Then you need to do another run. This run, you need to allow, once you determine what is the parameter to allocate the surplus, you feed it back into your actual model to do another gross cash flow by including the surplus sharing and also to reflect the cash flow after the reallocation. You need to bear in mind that, as I mentioned, reallocating of surplus is done vertically and it does not change the present value of the cash flow of the surplus because at the total fund level, the total surplus is the same. What you are doing here is just do a reallocation of cash flow. So by right, if you take a present value for at a fund level, the net surplus calculated from run A should be the same as the present value of the net surplus calculated in run 3. It's just that you are just reallocating the cash flow between groups. At the total fund level should still be the same. Okay. Once you do the reallocation of cash flow in the PRF level, then you can use that cash flow to determine what is the CSM at the total contract level. That can be used for TE reporting. You need to repeat that for BE plus RA basis. Okay. Again, it's the same thing. So operational challenge. So actuary modeling can't do reallocation of cash flow as per the requirement in B67 to B70. Why? Because it's so complicated. It needs to take into account the surplus distribution policy that the company had. Okay? So it's likely that the reallocation of cash flow would have to be performed manually. And then you rerun the model to reflect the fulfillment cash flow after allowing for the reallocation of cash flow. Due to different pricing assumptions used within the risk fund, it is likely that the net surplus going forward is likely to differ year to year. So this means that the company will need to derive the net surplus and perform the reallocation of cash flow for all future projection periods. Like in my earlier example, if the company write a whole life contract, and it's likely that you will have 99 years of cash flow, and you have to do the reallocation of cash flow for all the future projection period. Allocation of cash flow should reflect the surplus distribution policy of the company. Okay. Should all underwriting surplus be distributed? You have to check your surplus distribution policy, whether the policy allows you to keep some of the surplus aside. Okay. Can we have B71 reserve for future policy holder? So B71 reserve here refers to the unallocated surplus. If your surplus distribution policy say that you have to distribute out all the underwriting surplus every year, then you can't have B71 reserve in your modeling, because you should always follow what the company practice. Additional check has to be implemented for this manual process. As what I've illustrated, there's so many reallocation that you need to do for across the different projection period. You have to repeat it for different assumption. You have to do it for different sub-fund. There's so many things that you need to do, and this is a manual process. You need to make sure that additional checks is implemented so that you don't make mistakes along the way. For PRI, which is in surplus position, there should not have policy or group with negative PRI cash flow. As I mentioned, if the total fund is in surplus position, by right, you should distribute the surplus across all policies, depending on your surplus distribution position, right? You shouldn't have a situation where your overall fund is positive. However, some policies still need a cut. It doesn't make sense, because whether to distribute surplus or to have a cut is actually determined at the fund level, not at the individual policy level. Second point, PRF PV surplus sharing should remain the same before and after applying the reallocation. Again, just to emphasize the point that reallocation of cash flow is done vertically. We are just reallocating the cash flow between the group. And also not across the different projection periods. So by right, your present value of surplus sharing should remain the same before or after applying B67 to B70. Okay, as I've illustrated, the process can be very, very complicated, and the company need to do so many reallocation every time they do the IFRS 17 reporting. Is there any simplification can be done? There's some company thinking of some simplification. For example, assume same level of surplus distribution going forward. So instead of projecting the cash flow for the full portfolio for the next 99 years, and then determine what are the expected surplus coming out from the PRF fund for each projection period. So if you do that, you may turns out that, okay, the surplus in first projection years can be expressed as 2% of the tabaru. The second projection year probably is 3% of tabaru. The fourth projection year is 5% of tabaru. Okay, so by right, when you do the mutualization properly, every year should have a different surplus arising, and is also a different percentage of tabaru, right? So if the company want to do some simplification, they may say that, okay, in the past, we have been distributing 4% of tabaru. So we assume that going forward, we are also going to distribute 4% of tabaru going forward. So this will cut down the number of runs required, because remember just now we need to do 2 runs just to come up with the original cash flow, find out what is the fund position, and then feed back in after a reallocating of cash flow and do another 2 runs. So this simplification is trying to cut down the last 2 runs. So just do the first run, just assume the same level of surplus. But however, we have a challenge here. As I mentioned, it's unlikely that all future surplus will be the same. If you are assuming that the surplus distribution is going to be fixed, is this following the surplus distribution policy? Okay, so there will be under or over distribution of surplus. As I mentioned, if you do the proper projection, you may find out that the first year surplus arising is 2% of tabaru. Okay, but if you ignore what is going to be going forward, just apply a fixed 4% of tabaru as your surplus distribution. You are over distributing the surplus. Okay, one way to do that is that you can have a B71 reserve to do the balancing item. Okay, however, does your surplus distribution policy allow you to have B71 reserve to do the balancing things, right? And that would mean that every year you are distributing surplus on a different percentage. certain year you under distribute, like for example, your surplus distribution say that you need to allocate 40% of your surplus to policyholder, 40% to shareholders, 20% for B71 reserve unallocated. However, if you just assume a fixed level of surplus distribution, so definitely you won't reach that proportion, the correct proportion every year, because sometimes you over distribute, sometimes you put in more surplus into the B71 reserve. So again, it goes back to the idea, by right, you should follow the surplus distribution policy to reflect the, to correctly reflect the CSM for the contract level. Third point, some policy may still have negative cash flow after allowing for surplus distribution. This method kind of ignore what is your the surplus position in the fund. Say for example, for that particular group, expected claim is already higher than the tabaru. So you already started with a negative cash flow. Then you further deduct the surplus distribution to policyholder and also the performance fee to shareholders. This will make the cash flow even more negative. Okay, so if your negative cash flow means that you don't actually do the mutualization correctly. Another way is you start to do the asset share calculation for your PRF. So calculate what is the surplus arising for that particular policy based on experience, actual experience. However, we also have challenge here because there will still be policy having expected claim higher than tabaru. So who is going to cover the negative asset share for those loss-making policy? And also you are moving away from the spirit of mutual, because under the mutual model, all policyholders are helping each other. The profitable contracts are helping the not profitable contract. If you're starting to have your individual asset share, it go against the spirit of mutual. Okay, last slide, summary of implementation challenge. So there's still many uncertainty on the reporting requirement for Takaful. So like for example, RA, whether we should have RA in the Takaful fund. So what is the treatment of surplus distribution? How do we do mutualization in Takaful entity? So there's still many unanswered questions around the industry. So there are different progress made by the industry in Malaysia. Some companies choose to wait and make sure that the accounting policy, the actuarial policy, all the paper are finalized before they start the implementation. There are also companies choose to go ahead with the implementation and say that just follow the conventional way, and we will fine tune it later once the Takaful industry settle with all the question. So which way are you going? We still have about 30 months left for the life. So are you going to go ahead without waiting for all the question being answered, or you want to wait and see? Okay. Even though this is accounting standard, but actuary involvement in the implementation is quite crucial to ensure that the outcome of financial statement is correctly reflecting the features of Takaful. So we have gone through in the earlier slide, there are different approach for Takaful fund and Takaful entity reporting. So the main challenge remains with the ability of the IFRS 17 engine to do separate reporting. So the IFRS 17 engine in the market are mainly designed for conventional insurance. So we need people to fine tune the IFRS 17 engine to reflect the special features in Takaful. Okay. Due to the dual reporting, the two columns reporting, different disclosure and calculation are required. Okay. Because of that, you also have two different sets of results. Okay. Is that better clarity or more confusion? Better clarity is when, because you have two columns, Takaful participant can refer to the Takaful fund column to understand the health of the Takaful fund, whether there's enough asset to cover all the liability, whether the fund is healthy or not, okay? At the Takaful entity level, the investor then can find out whether the contract that issued by the company are profitable or not. So better clarity in the sense that it fits the purpose for different shareholders or different stakeholders, not shareholders. More confusion is there are two truths. Okay, both are correct because both are prepared and both are IFRS 17 compliant on standalone basis. So they are ticking the box for all the IFRS 17 standard. It comes up with two different results. Which result is the correct one? What happens if there is a policy holder and also an investor? Which columns of the result should this person trust? As I have illustrated in earlier slides, applying B67 to B71 to fully reflect a company's surplus distribution policy is quite challenging. So, however, this is vital to ensure that the estimation of performance fees to operators reflects the reality and it does not over or understate the CSM and TE level. So this is an area where actuaries should get involved during the implementation stage to help the business to integrate this new process into your future IFRS 17 reporting process. So yeah, I think that's all for my presentation today.
Thank you, Joanne. I think you've brought up some very interesting challenges, and I think people who are already doing this this implementation work, I think they've come to encounter this piece.
Yes.
There's some very interesting Slido questions, very specific questions, which you can tell are people already struggling at this stage. Shall we go to the Slido questions? There was, okay, one of the Slido questions was very basic stuff. They're asking why, you mentioned surplus distribution being one truth, right? There's only one surplus distribution. So why is annual cohorting still required if it's artificial under the TE reporting?
Okay, annual cohort requirement is a key requirement in IFRS 17 standard. So the reason why we need to have annual cohort, as I mentioned, is that ISB wanted the company to show the shareholders how profitable of the contract that you write at the annual cohort level. The reason, as I mentioned just now, annual cohort will have to be grouped depending on the commencement date and also the profitability profile. Yeah. So one thing is that I think ISB do not want the company to hide loss-making product. So when you start tracking under the current IFRS 4 basis, we are reporting everything at the fund level. So profitable product can cross-subsidize the loss-making product. However, once you start segregating the policy into annual cohort level or into the groups level, then loss-making product will stand out. Yeah. When the loss-making groups, the loss should be recognized immediately.
Yeah. It's just that for Takaful, you're allowed to take surplus from another group to cover the deficit in that particular, should have been onerous, but it's not because it's got other support from the other products, right?
Yeah, but these features is only in PRF, not in OF. So the complication for Takaful is that you need to hire the annual cohort requirement at the full entity level. Entity level will have cash flow from PRF, and OF. Yet you need to reflect that there's a mutualization in PRF. That's the challenge.
Yeah. So there's no running away from reporting at the annual cohorting.
Yes, correct.
That's right. No running away from that. Okay. Another simple question was, you've covered this quite well already, but can the risk distribution be formula driven? Why the complication of having had to do it manually? It's the last question at the bottom, Sylvia.
Okay. Can the B6770 okay, can the B6770 redistribution be formula driven?
Yeah.
Yeah, I think it's difficult, as I mentioned in the simplification slide. If you do a formula driven type of calculation, you may come up with a situation where the surplus distribution is not following the surplus distribution policy.
Yeah. So it's not something that can be simplified and be completely accurate. You can explore it, that you have in terms of percentage or tabarut distribution, but it's not going to be something that solves the equation. It needs to be explored, right? Okay, got that. Okay, next question was, okay, looking at popularity, right? This question, at initial recognition, do we determine onerous grouping or CSM loss component after mutualization or before? And is it up to the Takaful operator to decide?
This is an interesting question. I heard actually two. One mind is that, right, you need to do the mutualization to fully reflect the potential sharing of surplus from the old policy to the new policy, right? However, what happened, the risk fund is having a huge cut, right? So when you write profitable business into the risk fund, are you saying that all the future business is going to be onerous just because that there is cut in the risk fund? So yes, I think this one is interesting. So it depends on, I think this one will need to discuss with the auditors, you know, what is correct, because it's not fair to penalize the company that having a cut in the risk fund and say that all the future business is going to be onerous just because there's a cut in the risk fund.
Yep. Next question. Okay. A few just some housekeeping. I know a few people came in after we started, so don't worry about that. There will be a recording that is shared with participants, so you can catch up on the earlier parts. And after we've covered this technical question specific to Joanne's presentation, I'd like to invite the earlier speakers into a panel discussion. So there's two more questions here for Joanne, and then we'll move to the panel discussion. Okay, next question. Can we include B71, which is the unallocated surplus you were saying, to zeroize the surplus deficit, to zeroize the deficit, I assume, if the surplus arising is not sufficient to mutualize each other? CSM will not take impact for any deficit.
I suppose if you actually have a B71 reserve, by right you can. Again, back to the question whether your surplus distribution, but because how the risk fund works is that first, when you have like as I mentioned, the priority in the surplus distribution policy is that first you need to help each other. Secondly, if you have
built up past surplus,
past surplus, you can use that to help the current generation of policy as well. So that's the features of the mutualization as well. So yes, the answer is
you can So you can include that in your allocation. Right? Then CSM will not be affected. Okay. Correct. Next question. Surplus arising for mutualization should be on a net level. STOs distribute net surplus arising. I'm not sure what's meant by net. Do you catch that?
Net means, I think, net of Takaful, I believe. I think yes, because currently, because the surplus is determined at the net of Takaful level.
Okay. The next question is, you've shown from your methodology just now, Joanne, there's various manual and it's up to the operator in terms of allocation. So who's going to decide whether the simplification formula used to compute the allocated surplus is acceptable? Auditor or Takaful operator?
Of course, the ultimate aim to do this a reallocation of surplus is to reflect the correct profitability for that groups of business. So if you start to use some simplification method in your reallocation, so one question is, how different is your result using this simplification method compared to the method where you do it a very complicated way? Then that comes into the question of materiality, because I think auditor will always check on the materiality. So again, IFRS 17 standard is a principle based. It doesn't really tell you what method to use. However, the accounting outcome for all the different methodology that you adopted shouldn't change the economic phenomena of the business, like what Izana said. So if you adopt some simplification, you have to probably prove to your auditor and say that the simplification method that you have adopted is not that different from when you do this way, that which will take 2 weeks for you to complete. So
Yes.
you may want to prove it for a few rounds for the auditor to get comfort that simplification method works before you can, start adopting it.
So it should be driven by the auditor. It should be at the TO level. And then you get, as usual, you get the auditor's approval to use that, whatever method that you've chosen to use.
Yes.
Okay. Thank you, Joanne. So that covers questions for your presentation.
Okay.
I invite the panel speakers to join us here. Okay, so the Slido questions had questions specific to Joanne's presentation, but I've got some questions that were unanswered or wasn't clear before. Tizana, would you like to join us as well? And Shuhada?
Yeah.
Okay.
Let me get. You hear
Okay,
me?
yes, we can hear you.
All right. So I'll figure out how to put on the camera now. But anyway, continue.
Okay, we can hear you. Okay. Burning question. Takaful reporting needs to allow for separate ownership of the funds, and Joanne covered that. Like, risk fund is a mutual, participants looking at it to look at the health of the funds. How many columns is actually needed? Do you really need to have a separate column for, we understand the risk fund, we understand the Takaful entity. How come the operator doesn't get its own column?
I think perhaps I should answer that, because this is something which was actually presented to the TRG. So I'm a member of the TRG, and it was presented by in an MSB paper. And what the paper basically concluded is that you're given 3 options. You're given, the first option is that you have, first of all, I think just for those who are not aware of the history in terms of how we've come to this current conclusion, is that initially the MSB was just looking at just one column at the Takaful entity level. And the reason why they're looking at one column was the fact that you have only one contract, one insurance contract, and the contract is the smallest level of reporting, as it were. Okay? So legally you have one contract. So because of that, you just consider it as one entity and report just on that one particular basis. The issue then was that, okay, how do you account for it with one column? And the answer is you account for it like any other insurance company. And the reason that was suggested, I use the word suggested because it was never clearly sort of mentioned, is because of the card issue, right? Because you have a card, your card is a loan from the operator to the risk fund. Because you have a card, therefore there is risk transfer. And because there's risk transfer, then effectively you have insurance, right? So regardless of the fact that you have this mutualization, if you like, at the Takaful fund level, at a contract level, ultimately the underwriter is the company, and therefore it is insurance. So call it what you like, You know, a rose by any other name is still a rose. That is, I would say, the unspoken kind of reason. All right.
We kind of worked very hard in this past webinars to show that it is not actually insurance.
Yeah. And that was the first kind of iteration, if you like, in terms of how you should report for Takaful. Subsequent to that, you know, after some deeper discussion, we have to actually appreciate that the insurance contract is only one component that you should consider. You should also consider the regulations and the law of the country. And Malaysia, you know, we have very clear laws. I mean, Malaysia, basically, we never had a window. There's no window, no Takaful windows in Malaysia. Right at the beginning in 1986, when Takaful was first mooted in Malaysia, we had already separate regulations, separate act for Takaful. So regardless of what you say in the contract, ultimately that contract can be deemed to be illegal if you do not conform to the law of the country. A contract is only executable if it's a legal contract. If it's not a legal contract, you cannot execute it. So regardless of what's in the contract, you have to go back to the law of the country and see exactly how is this contract to be executed. So it was actually accepted that, you know, you have to allow for the IFSA 2013, and you have to allow for the TOF, both of which are actually enforceable in this country, right? So it's quite clear that as far as ownership of the funds is concerned, you know, Takaful funds, I be more than one fund, of course. You have the participants investment fund, and you also got the participants risk fund, and multiple risk funds, mind you, you know, are the ownership of the policyholder. I mentioned in my earlier presentation that, you know, this is different from the PAR fund in life insurance. The participating fund in life insurance is owned by the shareholders, not by the policyholders. Why do I say that? Well, when you wind up the fund at the end, if there's any surplus left over after meeting the expectations of the policyholder, that surplus is the estate, and that estate belongs to the shareholders, not to the policyholders. All right. So going back to the law of the country, because of the fact that the Takaful funds belong to the policyholder, it can be construed that it is actually also a reporting entity. So now effectively we say that's one reporting entity. So you must move away from one column to two columns. All right. Now the issue now will be, now, should there be three columns? Now, if you look in terms the current IFRS 4, the current IFRS 4 basically treats an insurance premium as the total premium that's payable under the contract. And that premium can include an investment component. But regardless of that, under IFRS 4, the full premium is recognized as the income to the company. It is basically part of the contract. Under IFRS 17, the principles is very simple. You only want to report, you know, in your revenue statement, what is the insurance component of the contract. Because of that, you have to look at the contract and you have to take out the investment component, right? Whether it's distinct or non-distinct as far as reporting for the purpose of the income statement is concerned, you have to take it out. Then you have to scrutinize again at the contract. Is there any other part of the contract which is not insurance in nature? And this is where, you know, the Takaful Operator Fund comes into place. Because effectively, you know, under the FSA, it says that the operator is not underwriting the contract. It's just basically an agent, if you like, of actually ensuring that, you know, the funds the Takaful fund is managed properly, underwriting is done properly. You know, it is basically an agent. A wakala basically is simply interpreted, you know, you are an agent, right? Except that it's slightly more sort of onerous in the sense that, you know, you are actually a trustee, which means that you have to act in the interest of the participants. That is what wakala means in Arabic language, you see, right? Simply translated as an agent. So now basically, IFRS 17, the premium, you see, we've taken out the, you know, reporting statement, we've taken out the investment component for the distinct or non-distinct for the investment, for the income statement. Now you should also take out, under IFRS 17, you should also take out the component which is not insurance in nature. Now on that basis, now that wakala fee is not insurance in nature because it's a fee for doing a service, right? So you have to take it out, and that has to be accounted under IFRS 15. Because all IFRS accounting standards now it is basically applied, in terms of what you provide, what services you provide. So there's a component of the premium that provides insurance services. There's a component of the premium that provides investment services. There's also a component of the premium that provides for, in this case, administrative purposes. So by right, that should be taken out. In the same way that you take out the investment component and put it in the PIA fund, all right? You take out the component, which is basically the services component, and you put it in the operator fund, right? So now you've got operator fund, IFRS 15, you've got the risk fund, IFRS 17. The issue now is the Takaful entity level, and this is where the problem is. Now, I mean, effectively, the standard, the MSB sort of say that, okay, you have three columns, 2 column, 1 column. And one question which was raised is that, does it mean that with 3 different options, you've got 3 different Takaful entity results? So 3 columns, you got Takaful entity result 1, 2 columns, you got Takaful entity result 2, 1 column, you got Takaful entity result 3. No. From MSB's perspective, it's all the same. Right? So that therein is the issue. The problem is that how is it now, depending on which number of columns you report under, at the Takaful entity level, it's all the same. Well, that's the magic of accounting. You go, all right, and that's what. But what I think going back to the questions, maybe I've gone too far away from the question. I think the issue now would be, this is the problem that we've got. I mean, that paper subsequently says that the proposal is actually to have 2 columns, and the reason why it's 2 columns is because of the fact that, if you have only 1 column, then the Takaful participant, which is also basically
you can't see it,
party, cannot see what is happening in terms of Takaful fund, because they are actually owners of the Takaful fund, but in accounts does not show. But as owners, you should also report to the owners, because what's the purpose of accounts? To report, in terms of investors. So
can I take you a bit further? So if in countries where there is no Takaful specific regulations, there's no surplus sharing, for example, would it be a very different way of presenting? Would it be operator 15, risk fund on 17 on a mutual basis? It's a bit easier to present. No annual cohorting. Would that be fit for purpose?
Well, I think if you look in Brunei, for example, there's no surplus sharing, all right? But the question
and other countries as well, yeah.
Oh yeah, in Middle East as well, because the issue is that is the terminology. Sharia is very clear. No surplus sharing is required. Even Malaysia as well, from that perspective, because surplus sharing means surplus can be positive or negative, and once surplus is negative, it's risk transfer. Okay. So in Malaysia as well, no surplus sharing. What you have is performance fee. All right. And this issue, what the performance fee is the one that results in Takaful entity column. All it's controversial in terms of what exactly is that performance fee, all right. But if you go to example Brunei as example, because other countries is the same, you only have basically, a wakala fee. You do not have any surplus sharing or performance fee, as it were. Performance fee is not there, all right. Now, if you go on the basis of, is there a risk transfer or not, all right, and you see that there is risk transfer, then effectively, you have to account at the Takaful entity level, as insurance, and therefore the annual cohort applies. But then, what does it mean if annual cohort applies? I think that is the key. But to simplify, you can say, okay, IFRS 17 only applies to the risk fund, and that's fine. Okay, we do as what we require, and we do it in Brunei, we do as what needs to be done. But at the Takaful entity level, it's actually just like an operator. So the IFRS 15 applies. So that could be one approach, and that's the approach I think they should seriously consider, given the complication that Joanne has mentioned just now. Now, what's important that for those people just ticking the box, there's no way you can run away from B67 to B71. No way. All right, because the reason why you have IFRS 17 is to ensure that reporting among all insurance Takaful entities are consistent, because they want to be comparability. Right? So the only way you can argue that you can do a simplification if you can prove that there's no materiality in terms of as if you've done it the right way. And you know, you have to do this every year. Now, if you want to do it every year, there's no materiality. Might as well go and do it, you know, in a particular way.
And the one thing that Joanne pointed out was that if the risk fund has a surplus, right, which means even by annual cohorting, you would have no group that would be considered onerous, right, Joanne?
Yeah, the surplus in the PRF. So the onerous, if the PRF fund is in surplus position, the only reason why the cohort is onerous is probably coming from the expense deficit.
Expense deficit, right? That's true. I always forget that part. So the expense side, whether that, but if things are okay and there is a surplus on the expense side, then you know all this work, all this work to do, but you won't be able to pick up any onerous contract because you know there is surplus within the fund to meet that deficit. And if your expense is in a surplus position as well, then you know there's no onerous contracts to highlight. That's, you know, just thinking in the big picture. Let me just take some of the questions on Slido. Is Takaful contract 1 or 2 contracts? Okay.
Who's going to answer this first?
Let me start with this one. With this one. This one's an interesting question, actually.
Yeah.
The reason we say this is an interesting question is that if you look at Islamic banks, you have one type of banking product, but it could actually be a number of actual contracts built in as one. So when you're looking at banking accounting, you very clearly have several different contracts in place. So it's clear in the banking side. And what you pointed out with your question is absolutely true. And that actually we have multiple contracts here. We have one contract, which is the participant is entering a contract with all the other participants. I'm going to join in with all of you, for better or for worse, sickness and in health, to see, I'm going to share in my surplus with you. And this is not a theory, this is a reality. What Joanne showed today was, this is the reality. You know, you can have the most profitable product, profitable policy coming in, but if you're entering a risk fund which is toxic, that's going to affect you. And reverse as well. You might have something which is less, you know, your policy is struggling, but others are not struggling. So you have a contract directly with all the other policyholders, the other participants. So that's one contract. But you also have a contract between the whole risk fund, all the participants as a whole, with an operator to actually manage your fund, do the investment income, provide some timing assistance through the card if necessary. So yes, there are 2 contracts in one. The tough question is, can we actually look at each contract independently? Or because they're not formal contracts, does this mean that we have to look at Takaful as just one contract? And actually, that's the hard part.
Yeah. Legal perspective? We just signed one contract, right?
Legal perspective is just one contract. But then, you know, IIFP has made it quite clear that we're looking at how things are working, not so much the legal aspect of it is less important than how it's working in reality.
Form over substance.
I think, yeah, that's exactly it. It's a substance over form. Effectively, you might have one contract, you know, so form is one contract, but you can argue that in substance is actually 2 contracts. I think people are not actually sort of apply. Actually, thinking about accounting standards is that, you know, it's all driven by, you know, principles. And I think the people in this webinar, you know, I would refer them to the 2010, 2018 conceptual framework for financial statements, which is basically ISB sort of, if you like, you know, Bible, you know, in terms of whenever you do anything, make sure you follow this Bible. This applies to basically the board that puts the staff of ISB, the board, the ISB, the working group, you know, have to follow this Bible. And effectively, you know, the concept there is that very important that when you do accounting, sort of substance must actually override form. You might have basically a legal contract, one legal contract, but what's the substance of that contract? Another thing that the framework does say as well is the application of probability, right? So when you do accounts, now you're actually making a statement in respect to what the investor can expect. So the issue is that, you know, if you actually have for example, give an example that you actually made a sale of a land, you know, effectively the people has paid the deposit. It's not paid the full amount yet, but it's paid the deposit. So in terms of that sale has gone through, in all probability, you can actually reflect that in your accounts because you paid the deposit, you know. So this issue here in terms of card is the same thing. I mean, the issue is that, you know, if card is written off, then there is actually a risk transfer, and that's why in the Middle East, you know, under AOFI standard, you cannot write off the card, because once you write off the card, you actually breaking a fundamental principle of Takaful. For it to be Sharia compliant, it must be risk sharing, not risk transfer, right? But going back to this probability concept, to the so-called the Bible of the IFRS, ISB says that, you know, you go on the basis of probability. So the question now is that what's the probability, first of all, that the card arises, right? Maybe the card will never arise, you know, it is all theory, all right? Or yes, it could arise, but, you know, in all probability is more than 50%, or I think in the concept of IFSB, it must be more than 60-70%, you know. Yeah, in all probability, you know, the card will be repaid. If that's the case, then effectively substance over form applies, and that effectively that it is the real mutual. And at the Takaful entity level, you are basically just an operator. You're just managing the funds on behalf of the policyholder for a fee. So I think you have to go back to the basic principle. And the other one, of course, is the outcome. Ultimately, you must make sure that whatever principles you apply, the outcome to the policyholder and the outcome to the shareholders must be unchanged. The standards is not there effectively to change the economic outcome to the stakeholders. Outcome to the stakeholders must not change because simply the accounting standards move from IFRS 4 to IFRS 17. No. What the transition from IFRS 4 to IFRS 17 has done has changed the recognition of the profit. The profit remains the same, but how you recognize the profit has changed to IFRS 17. How you recognize the revenue has changed to IFRS 17. But otherwise, everything else is the same.
True. We've got some questions on Slido which are pretty technical. Shu, do you want to take the first one? They're asking whether do we need to allow for future expected card in calculating the fulfillment cash flow, since it is an outgo to the Takaful operator fund?
Sure, Iza. Okay, so okay, let's look at what's the purpose of the fulfillment cash flow. You basically trying to determine the present value of future profit, right? So in a way, if there is a cut, you know, you're implying there's a deficit. So calculating the fulfillment cash flow would inherently calculate whether there's a profit or whether there's a losses or deficit, or in other words, there's a cut. But I'd like to bring back in terms of how does a company determine a cut. The cut is determined on a total fund level, not on a per contract level. So you probably need to take a look at the fund level, whether there is a cut that would arises on a total fund level. And going back to Joanne's example, I think, you know, if you're going to project a cut on a total fund level, that's quite bad, isn't it? Because you're assuming the total fund is in deficit, which I think going forward is not something that the company would be writing on. So yes, so simple answer to this, yes, when you do your fulfillment cash flow, any deficit would be taken into account on a policy level, but the definition of cut is on a total fund level. So it's very unlikely that you're going to have a cut being projected at inception for the total fund level. I think practicality, you wouldn't be seeing a cut on that total fund level basis. Yeah,
you're not doing your job really.
Yeah, yes, right. I mean, why would you project?
Well, you know, I think Shu, I think, you know, you are a GI actuary, GT actuary. So,
Yes.
you know, it basically you go back to this thing about, you know, that before we have this tariff, and, you know, you have to sell unprofitable policies. And, you know, I think IFRS does actually refer to contracts which by law, you know, you might be forced to take a loss, and how that should be treated. So if you will take that into account, that you're going to continue writing this business, then you're going to have a losses, if you like, coming through. But like you pointed out, you know, CAD is determined at total fund level, and there's no way. I mean, one thing in Malaysia that we do is that we do what you call FCR, financial sort of financial reporting of the company. And in that perspective, you know, you can allow for the losses going forward. But certainly, you know, it's not something that at an accounting level basis you would do, because accounting, you're looking at, you know, the current block of business. And one thing as well, you know, just to clarify, you know, when you determine a card, it means that, you know, your fund, the fund that you've got is actually less than the present value of your future guaranteed benefits, right? Which means that, you know, don't talk about your performance fee from that perspective. There's no performance fee. There's no surplus distribution to policyholder.
You'll be in trouble with your shareholder.
And this is a guaranteed benefit, and this is basically your fund, and there's a difference, and that is the card. And the issue will be that, you know, that card, you know, whether if you repeat or otherwise, that is the FCR that you've got to do to see whether you repeat or not. Because as far as the auditors are concerned, in Malaysia, we're quite strict on this one. If you cannot be seen to be repaying your card, you have to write it off, right? Regardless what Sharia say, you know, we have to write it off, because then it will not reflect. You might argue that effectively, you know, that's risk transfer, but I won't go that route today. You know, that's you know, but you have an issue. You are looking at if you like, you're looking at current block of business. You're looking at current fund. Is it card or no card?
Yeah. And then it's up to the operator as well to choose the how long the card will be repaid. So you could say over 3 years, you could say over 10 years, but I would expect that you want to be able to repay that card.
Yeah, and something as well that people sometimes might forget is that, you know, the FSA is clear to say that now, if the card is still outstanding, no performance fee can be paid. You can still pay surplus to policyholder, right? So you have a card, but then your new policies are coming into the book, you know. You can say, never mind, my surplus distribution policy, that even if there's a card, I'll still pay surplus to the policyholders, but otherwise new block of business might not come in. But there's no performance fee.
You can't take performance fee
until the card is repaid, you know. And that's the reason why companies normally, you know, they just don't want to have a card, because once you have a card, because
they don't want to impair the card.
That's one. But also now, if you effectively you have a card, you don't get any performance fee. So all surpluses,
you want to repay as fast as possible.
You even profitable policies that goes into the book, new policies that goes on the book. You know, you still actually use that to repay the card first, because if you say, okay, new policies coming in the books, let's make sure that they do have surplus distribution. We sort of isolate them and we calculate the surplus for them, and then we pay the surplus. But because there's a card, there's no performance fee. So basically, that's basically up to the operator. You know, you to be fair, that's what you should do. But people won't do that because they won't get any performance fee.
Let me add one more point to that one. I think where I'm coming from is that looking at the current books of business, which is most of the companies are pretty much matured as far as general Takaful is concerned, it's very unlikely that they're going to have a card unless, for example, it's because of a reserving strain, for example, because you're growing too fast, too big. But you know, for new entry to the Takaful industry, for example, the card would still be expected coming in because of the fact that you're going to have reserving strain, from the fact that you are keeping 75th percentile instead of 50th percentile, and the fact that you are growing, you know, very aggressively. So there is a potential for cut if you're talking about new entity, new business entity.
But that's a temporary strain, as you pointed out.
Yes, exactly, because it's a reserving strain, it's a growth strain. So once you reach to a certain level of the business whereby it stabilizes, then those strain will be released and you're going to get that profit, you know, being recognized in the later years of the business.
So we've discussed this at length. So what is the short answer? Do we need to allow for future expected cut? Yes, but at the risk fund level, right? Not at the policy contract level.
Well, I think Aizal, it is for FCR. I think I mean, you know,
Okay.
because on the IFRS 17 level, you know, I mean, I don't think that auditors will allow you to allow for, you know, because one thing is that if the when you do consider, when you consider fulfillment cash flow, you're looking at current contract, all right? And that should be profitable or otherwise, no. But card is at the fund level, so you're accounting at the fund level, so it's a bit more more difficult.
Okay.
Yeah.
Okay. The next two questions is on Takaful. I think Joanne, you probably modeled this a bit. So let me pose this question to you. I'm going to read both out. Okay. Due to the boundary, I think there's a contract boundary for gross and Takaful held are different. The surplus arising after Takaful will not be accurate. Should we do any adjustment to cater for this? And the related question was, Bank Negara Malaysia Takaful has held boundary does not consider any unissued gross level contract, while MFR 17 considers them. Do we distribute surplus using 17 or Bank Negara method?
Okay, first question, yeah, correct that the contract boundary for gross and RT are different. As illustrated in my earlier example, we need to calculate the cash flow for the gross contract and the Takaful contract separately. And then from there, we can determine the surplus cash flow, okay? So over here, we're still talking about the cash flow level. And of course, the length of cash flow projection we need to take into account the boundary. So for the gross contract, it could be 99 years, but the RT, it could be only, 2 years, for example. Most likely is longer, should have a similar contract boundary as the gross contract, but it's just for the extremes example, we have a gross contract of 99 years, but RT has a contract boundary of 2 years. So the surplus distribution, so the surplus calculation will look a bit funny that you have a 2 years of surplus taking into account the RT, but from 3rd year onwards is without the RT. I believe you will have to reflect that because this is the standard requirement to ask you to reflect the contract boundary of each of the contract. So you will have to reflect the surplus sharing cash flow with that basis, or else there will be a mismatch. You recognize the gross liability using a 99 years cash flow and your RT using a 2 years cash flow. By right, your surplus should be calculated similar way as well. And also, as illustrated in my example as well, the surplus cash flow would then be parked under the gross liability calculation, right? So your surplus cash flow will have 2 years of net surplus taking into account the RT, and then the remaining 97 years without taking into account the RT. And then this cash flow will have to park into the gross cash flow and then do the recalculation again. So I think this will be the correct way to do it. So we have to take into account the boundary without doing any further adjustment to it, or else you will have a mismatch between your gross liability, net liability.
The next question talks about Bank Negara, but we know that it's a draft, a QIS, if you like. So there is no standard issued by Bank Negara. It's just an approach that they were testing, right?
Yeah.
Yeah. So, I mean, Bank Negara would be concerned about solvency, and I think what they're trying to marry is not to cause too much redoing sort of issues and trying to reflect the 17 standards into what it needs to be reported.
Yeah.
So
Bank Negara is more for your solvency concern, and you distribute surplus if the company is solvent. But IFRS 17 is more for profit recognition. So it's just that you can't recognize all your profit at inception. You have to spread across the profit. You recognize it over the duration of the contract. So the profit arises from MFRS 17 may not be, in my opinion, it's just to recognize the profit. Is not for surplus distribution purpose.
Yeah, it's profit recognition. Your surplus distribution, we should look back at your surplus distribution policy, right?
Yeah. Just like for par fund, all the
that's a good example. Yeah.
But MFRS 17 is going to level make all the surplus, make all the profit to be level distribution throughout the projection year. So, but the real surplus, the dividend distribution is only towards the end of the contract.
Next question, still on Takaful. How do you treat Takaful covering different products across different PRF? For example, medical riders in Takaful Link PRF and individual family PRF. How do you treat Takaful covering different products? Are we clear on the question? Yeah.
Not too clear. Is that related to contract boundary? Because the grouping, the level of aggregation for gross contract and Takaful contract has to be done separately. So the Takaful contract, it covers a different groups of products. You have the one annual cohort by itself. So your RI will have, it could be that on your gross calculation, you have 3 different cohort with medical rider and individual family having a separate cohort. However, for the RT, given that there's only one contract, you will only have one annual cohort.
Yeah. Next question, we're back to discussing card. I think card is an issue on most people's, what they're facing, but don't have quite a good understanding on this. So the question is, as future expected card is calculated at fund level, not included in policy level, how should we reflect this under MFRS 17? So I think the question is really, how should card be reflected in 17? It's a loan.
No, I think, Aiza, just one thing, I go back to what I said just now, in terms of the financial conceptual framework for financial reporting. And just to include one very, very important sort of concept for financial statements under ISB, and that is that, as far as the modeling is concerned, it is based on the expected model, right? Now, this is going to be challenging at the TE level, because if you were to tick that box, and I've always been saying that, you can't tick the box, but I'll just give an example why ticking the box might actually sink the boat. Should I say, I make it non-Sharia compliant as far as TE level is concerned, really. Because you were to tick the box, on an expected basis, if you have a card, you have to write it off. Right? That is, you want to tick the box at the TE level. So there's no such thing as a loan under IFRS 17 now, because it's on an expected model. So if you have, for example, the fund is 100, while the liability is 120, you expect to make a loss of 20. Under IFRS 17 standard, losses, expected losses, will have to be written off to the P&L. So if you want to tick that box and say, yes, this Bible says you have to write it off, the 10 commandments, if you like, then effectively you have to write it off. And once you write off the part at the TE level, it becomes like conventional insurance. And then you have Sharia compliance issue. So that I think, is something that people are staying away at this point in time. And this goes to, maybe this is something that, that everybody needs to consider very carefully, is that, it's no good to actually say this is the way to do it in theory if you cannot actually implement it, right? When ISB put IFRS 17 standard together, they had QIS. You had some companies actually doing the calculations to make sure that what the ISB says can be implemented. But here in Malaysia, we're putting the cart before the horse. We're saying this is a theory. Tick the box, this is a theory. Implementation-wise, well, we'll think about that when we come to the bridge, you see. Which is very, very sort of, it's not basically something which is, it's not something which is, you should consider, because ultimately you're spending a lot of money in terms of doing this implementation work. And you don't want to say that at the end of all this, you have to go back and start all over again. Who's going to pay the bill? Okay, say my piece.
Sure. I guess address the Slido question first. Should positive negative CSM develop for Takaful?
Not so clear what it means, whether I think the question referring that whether we can have a negative or positive CSM for Takaful. I think the answer is yes. I think for Takaful, unlike the gross measurement, gross contract measurement, you only can have a positive CSM. If you have a negative CSM, it means that
It's an onerous, yeah.
onerous contract, and then you have to recognize the loss. However, for Takaful, you can have both way, either positive or negative.
Yeah, I think that's a correct answer. You can have a Takaful gain or Takaful loss, and you don't have to present value those losses like an onerous contract. Yeah.
And
Okay, let me.
Sorry, before I forget, there's a good actually a point there, Joanne, because the issue here is that you have, for example, Takaful or reinsurance, and you have the situation where reinsurance treatment is different from the gross treatment. In the gross treatment, negative losses you can recognize immediately, but under Takaful, you can actually amortize it, losses. So if you treat you retreat operator, I would say this blasphemously, as a Takaful operator, all right? Then effectively, if there's any, you can actually have negative CSM. So you're actually also amortizing the losses, over the duration of the policy. And, I think people should explore that, because this is not in the IFRS 17, but again, I go back to this conceptual framework for financial reporting, because one of the things as well, that framework applies for reporting standard after 1st of January 2020, all right? And effectively, if you were to apply that standard, well, that standard as well, you can apply it, if you like, as an overlay to all the IFRS 17 standard, because it's not clear in terms of the standard, or no standards actually applies. And you can argue that as far as Takaful is concerned, there's no standard for Takaful, then you can actually have your own so-called ISB consistent standard and still sign off to say it's ISB compliant, IFRS compliant. Effectively, you're saying extrapolating a bit in terms of what you want to achieve, you have negative CSM. So something for the industry to think about.
Yep. Yeah. Okay. So what we've covered today at the panel, and also from all these previous webinars, is that we've covered that Takaful reporting needs to allow for separate ownership of the funds. We've talked about that at length. The question whether 17 applies to the risk fund, yes, but it needs to allow for the mutualization aspect. And mutualization would imply there's no necessity for annual cohort and no CSM as well. Joanne's pointed out that annual cohort is a requirement for 17, but we can show that results using annual cohort will be the same as the result without annual cohort for Takaful risk fund. And because of that, we say annual cohort is not necessary, because policyholders are sharing risk amongst themselves. On the operator fund, we discussed this. It's not quite clear cut. Entity level, the way MASB and the way Malaysia is going, it's on 17. But the challenge is, which Joanne spent the whole morning explaining, is how to allow for that mutualization and fit that into the annual cohort requirement. It doesn't sound very easy. There's no, formula, so no coding that you can do. You have to do this in a manual way for all the runs that you've done, vertically as well as horizontally across the projection years. Can we spend a bit of time in terms of reconciling this bit about, you have two approaches in reporting of the same contract, because you have one method, one approach for the risk fund, but on the TE, it's another approach where you're allowing for the annual cohort. Wouldn't that raise confusion for someone looking at your financial statements, and which account would be true and fair? Can we spend a bit of time discussing that?
Going to start. Hassan, you start.
Hassan, instruction from the boss.
Oh, is it gone for Friday prayers already?
No.
Not yet.
Catch him first, yeah.
Catch him first, yeah.
Somebody else start. Let me get my brain around it first.
Aiza, you start.
Okay. So when I discussed this with Joanne, I think, and Joanne's already included in her presentation, the Takaful Fund is really a column for participants to understand whether the PRF is healthy. So when you as a potential participant or an existing participant, I want to know whether my risk fund is being managed responsibly. So I would be looking at that column. If I see any deficits in there, I'd be concerned. But the TE is useful as for an investor, right? And the TE is because you're looking at present value of future profit, you're looking at CSM. So I guess for an investor, that's more useful. He'd be concentrating on the TE. But what happens if you're also a participant as well as an investor? Which column do you trust? I think it's from different perspective rather than trusting one over the other. Of course, the TE column is looking at how the business is being managed rather than how the risk fund is being managed. Anything to add, guys?
I mean, that one's a very good point. I mean, we have to keep that one clear when we're talking about Takaful, is that we don't have one stakeholder in Takaful. We're not doing this just for a shareholder, from a shareholder's point of view, because we've got multiple owners. Because of this multiple owners, we have to have a risk fund accounts as well as a, overall entity level. I'm hoping that over time, people will be able to understand the difference, the nuances of Takaful better by having these multiple columns. To me, it would be beautiful if a Takaful participant can look at the accounts of a Takaful operation and see the risk fund might look miserable because the company is taking too high wakala fee, for instance. And yet they look at the Takaful entity point of view and, wow, it looks great. It's really profitable for the shareholder. I would love it if that nuances came out, or the other way around, that the product, that the risk fund looks nice. It looks beautiful.
Healthy,
it's a good, healthy. It's something that, okay, I can easily put my money in and I can be expecting surplus. This risk fund is being run in a good manner. Maybe they're being too good to us because now we can see losses on the operator's side. But to me, if I'm hoping over time, this will bring out the beauty of Takaful so people will understand exactly what Takaful is much better, inshallah.
Yeah.
I think basically, you see, ultimately, I don't see a way that, you see, the point is, the three-column approach that MSB option one, as it were, we've got Takaful operator, Takaful fund, and Takaful entity. Going back to what Hassan mentioned just now, the issue here is that, if you are actually an investor, if you have three columns, which column would you look at? Would you look at the Takaful operator column, or would you look at the Takaful entity column? Which one is actually relevant to you, is it? And I think that is a fundamental question that you need to address when you determine, whether you use one, two, or three columns, as it were. I think. But just in case we run out of time, this one interesting question in Slido is that there was mention of using IFRS 15 for wakala fee. Is this a reality or a proposal? This is allowed for actually under IFRS 17. In fact, it's something you have to do because, as I said just now, under IFRS 17, what IFRS 17 does is that it takes the premium and it actually dissects the premium, all right, in terms of which is insurance and which is non-insurance. So the investment component, non-insurance, out you go, all right? The wakala fee is non-insurance, out you go. So if you want to go on that basis, then you have to apply IFRS 15 for the wakala fee. And MSB recognizes that. But MSB is saying that, you don't have to show it, because
from a cost perspective, right?
From a cost and benefit perspective. But I would argue that, from the perspective of information, you cannot actually avoid that, because from the operator perspective, it will tell the shareholders, how much money that the company is making at the wakala level, And here, wakala fee, you have to define as well. What is wakala fee? Is it? Does wakala fee includes performance fee? Because fee, is IFRS 17 says fee. It doesn't say this fee or that fee. Okay, it says fee. So once we define the performance fee, should performance fee be accounted under the operator column, or should performance fee be accounted under the Takaful entity column? Because I go back to my point just now. You have three columns. should the investor be looking at the Takaful operator column, or should the investor be looking at the Takaful entity column, right? So we are asking more questions than perhaps than we have answers at this point in time.
I think it's a discussion. We're not here to say which way is the best correct way.
Correct. And then the point here as well, if this is the reality, could be the CSM be 0 after 17? Right.
Yeah, I mean, if you're writing a mutual, I would say that's very...
Yeah, but the point is quite a good point actually, because you can argue that at the Takaful ND level, when we started discussing how to apply
Yes, we were arguing with the auditors a lot over this.
Two CSM, then we say, oh, never mind. It should be maybe only one CSM. Then one CSM, is it in the operator fund, or is it basically in the Takaful fund?
Yeah, and I remember my argument with the auditors as well is that CSM is that a given, because you've got policies and restrictions in how the surplus should be distributed.
Yeah. So maybe CSM should be 0. And
let me jump in.
Sure.
Let me jump in.
Come on, Hassan, before you go off. And then we've got Friday prayers.
Yes. Okay. Let me give an example for this one, just to make it a little bit clear. Let's pretend you're starting Takaful in a new country, okay? Let's pretend that the benefits are not guaranteed, okay? Just pretend for a minute. This wouldn't be for a compulsory, motor policy or, mortgage reducing term. This could be for health policies or whatnot. So the benefits are not guaranteed, okay? So there is no card in the shareholders. The shareholders and the operator is strictly managing this business for the benefit, for the use, for the benefit of the participants, okay? So you have a risk fund, which is totally taking care of themselves. And you have an operator's fund, which is dealing with expenses, managing it, making sure, the underwriting is proper and everything like that. And they get their wakala fee, okay? So that wakala fee would clearly be IFRS 15 in the operator's fund. That would be dead clear because there is no surplus. There is no risk transfer here. But this risk fund is still going to be a mutual entity. So this mutual entity, if it is a long-term contract, if it is, say profitable, I would say there's still a CSM there, but there's no cohorting. It would be, it'd be done in totality. And there's rules in place under IFRS 17 for mutual companies, for mutuality, to be precise. So it talks exactly about the situation. So homework for people not familiar with it would be to check the IASB website for their section on mutuality to see how exactly that's being dealt with. Can we bring that in for Takaful?
Joanne's spent a lot of time explaining that this morning. Ari's got a question. Because I know this is your client. I'm wondering, for all cohort policies that is loss making due to IFRS 17, should this be paid by the operator if previously this is profitable and TO get their share? This is, I guess, the when you've actually distributed your dividends based on those old profitable policies, and under 17 suddenly it's no longer, money's no longer there.
I think this actually, this is actually a quite interesting question as well from the perspective of implementation for the purpose for conventional companies, right? You look at an insurance company under IFRS 17, at point of inception, you have to reassess the policies that we sold in the past. And if under the previous IFRS 4, you already made a profit and you transfer that profit. And in my presentation on Monday, I showed that one of the differences between IFRS 4 and IFRS 17 is the way in which surplus is released. Under IFRS 4, surplus is released at time t equal to 0. And effectively, if you were to do that, then you have distributed all the surplus that will ever emerge based on your expected cash flows at time t equal to 0.
Yeah, we see that happen for the mortgage products, right?
Yeah.
For the single contribution mortgage products and MRTT products.
Some companies have dividend all off already.
Yep.
Right?
Yeah.
And profit is not yet earned, but you already dividend off. Then when you put in IFRS 17, you say, oops, wait a minute, I should not have dividend off. Then under IFRS 17, you got to actually reduce your retained earnings for that amount. And effectively, if you don't have any retained earnings, you are actually insolvent. So there's a danger there at the point of inception. If companies effectively has distributed all the profits that ever is going to emerge under your cohort of on your book of policies, that you can be insolvent after 17 inception, right? Now you go back particularly to this particular question, all right? So participants have got your share, because in the previous IFRS 4, you got your share. In the previous IFRS 4, shareholders have got their share. And then suddenly, IFRS 17, wait a minute, we should not have distributed that, because you should have kept it, if you like, as a CSM or as present value of future profits to be distributed. Because you need to actually recycle, if you like, your profit. The word is recycle. You got to take back the profit that you had distributed in the past or recognized in the past and recycle it to the future. Right? So, of course, the way to this is that you can do this because then you have to reduce the retained earnings of the company, and then, shareholders say, hey, wait a minute, this is actually not risk transfer, it's risk sharing. Why you take the money back from me? Is it? That's my performance fee. People tend to interpret things to their advantage, If it's not to their advantage, it's a performance fee, it's a fee. Therefore, I cannot give you back the fee. If it's risk transfer, then actually it's a surplus. And therefore, I have to give you back the surplus, because if there's a surplus, now it's not a surplus, I got to refund it back to you with it. So you have to be consistent. Is it a performance fee or is it a surplus? If it's a performance fee, sorry lah, you're already given to me. I'm giving you the service. Cannot lah, But if it's a surplus, you can argue it should come out from your retained earnings. Of course, you can't chase the policyholder, but you can still chase the operator.
Yeah.
Interesting.
There's also a trick to this, Arif, that, obviously we had this conversation with our clients as well. It's also how you allocate your expenses. So if you can prove that your acquisition expense in the past was actually very high, then you don't really have that much profit to recognize at inception. Yeah. So it's also assumption driven.
We all know what the issues are when you do the runs, at transition, what does it look like? But this is a very interesting question for Takaful, actually. What happens at transition? Because under IFRS 4, all the profits has been recognized at the time the policy is incepted. But under IFRS 17, you got to recalculate it and then recycle it going forward.
I'm gonna have to let our participants go shortly, because it's Friday. It's gonna be Friday prayers soon. Any closing remarks or burning questions? I invite participants to unmute yourself and ask your burning question, if that is preferable. I'll give you a few minutes to do that. But at our end, is there anything you want to close for this panel discussion?
I think I go back. What was the important thing I said just now? I think, for those people in this call who are responsible for IFRS 17 implementation in their company, I would really urge you guys to actually determine, early whether what is actually being proposed is actually implementable. Because there's no use actually going on the theory if you cannot implement it. And the problem that we've got is that we're not actually looking at whether it's implementable. We're just considering the theory at this point in time. And we're actually having this big discussion what it should be. But you should only have options if the options can be implemented. If the options cannot be implemented, it should not be on the table.
And to add to that is, because it's principle based, you can have options in terms of the way you adopt it. And you should be open to exploring options that work for you as a company.
Correct, yeah.
Okay. Thank you, everyone. I don't think anyone's unmuted themselves to ask. Thank you so much, ASM as well, for organizing. We actually had a very stimulating conversation in the past 2 weeks. Thank you for participating. You've got our email if you need to ask any more questions or speak to us. Thank you to the speakers. I think it's been very fruitful for everyone, because we do try and make it more, practice oriented, more rather than just discussing what the 17 Bible says. Okay. Last words.
Thank you for being patient with us, and actually, especially for those people who have been with us through all this 5 presentation. If you just write to us, email to us, we'll be very happy to give you a certificate to say that you have actually gone through the Learn an AP, no Takaful IFRS 17.
Yeah. If it's something of value to you, yes, please write to us, and we will send you a Learn at AP, a certificate to say that you've attended all 5 series. We've also got it on recording, so I know some of the bits are pretty technical. Sylvia will be sharing that link to the recording for you to download. Okay.
Thank you,
Thanks.
everybody. Bye.
Bye.